Right, hi there. So this is part 5. We're now moving on to fixed overhead absorption rates. Now, I'm going to use this example to kind of explain this. And I'm going to do it the old accounting way and tell you what's really going on. So what we have here is a situation where somehow we have assumed, and I'll explain it, we've sort of agreed somehow that we can treat fixed overheads like we do with variable costs. So now the first thing here is that fixed overheads are not variable. They're just not. They're fixed costs. They could be rent, they could be salaries, but the key point is that they are fixed and they do not vary with volume. But for absorption costing, we sort of we kind of, in terms of maybe setting a quote, we create the idea of a fixed overhead absorption rate, so we can put an element of fixed costs into the making the product. So we can say something like, oh well, which is exactly what we see here. We can see that, well, we have a budget of 22,960 over a number of units. So we can assume somehow that if we spread this cost over these units, or if you like, do a fixed overhead absorption rate, so we can sort of say, well, we believe that we will have, we believe that we're going to have 22,960 and we're going to have a total of, it says that the standard time to make each unit. So we can spread these costs over those number of hours. We can say we wish to absorb that. And if you divide 22,960 by, so basically 22,960 divided by 13,200, you get £1.75. So you can almost say that each hour of fixed overhead generates £1.75. It doesn't really, but we can think of it that way. And there is an accounting purpose to this, because think about it, when we're preparing accounts, as I'm going to show you, we cannot wait till the end of the year before we see the actual total cost. We want to start putting things in now. So after everything I've just said, so that's kind of this first bit, A. Now, the real and only variance, imagine this was rent. We thought our rent was going to be 22,960. Actually, our rent was 24,200. So we thought the rent was going to be this, and this is what it actually was. Now, the difference between this and this is the actual only real variance. And that, if you like, is 24,200 minus 22,960. And this is equal to, let's calculate that, 24,200 minus 22,960. And that is equal to 1,240. This, if you like, is the only real variance, and this is what we actually call the fixed overhead expenditure variance. Right? So this is referred to as the fixed overhead expenditure. So what does that mean? The fixed overhead expenditure variance is literally the variance between what we thought costs were going to be. That was a budget plan. That was exactly what it was. Maybe that's what we paid last year. And what it actually is. Now, coming back to my £1.75 issue here, and this is what we're going to deal with here. And this is really to do with this idea of accounting. Now, when we prepare our accounts, especially management accountants will say, okay, listen, every time you prepare your accounts, you have revenue and you have cost of sales or whatever production costs, and you have these variable overheads and you have a fixed overhead. We want to kind of start putting something into the accounts. So what management accountants are doing is this. They will put in, they have assumed this £1.75. We don't know what the bill is going to be at the end of the year. We don't know what's going to happen at the end of the year. But we say, okay, we think it's going to be £1.75. We are assuming that you will spend 2 hours on each unit. So in effect, we're going to put in £3.50 for each unit. So think of it like £1.75 for each hour, but we have 2 hours for each unit. And for every unit we make, we will assign this thing to it. So let's go back to what actually happened. Well, over time, you have now made 6,460 units. So over this period of time, you have made 6,460 units. So every unit you put in £3.50. Over time, you've made, if you like, 6,460 units, because that's what you agreed that you would assign to each unit. So at the end of the year, you will have a figure that says £3.50 times 6,460, which comes out at 22,610. Now, you'll go back, and this is what is in your accounts. This is your accounting cost. This is your accounting cost for the year for fixed overheads, right? Based on your kind of good accountant behavior, 22,610. Now you go back to the end of the year and you'll see that actually what happened was that the fixed production costs were actually 24,000. So you'll see that the real thing, I'll just change my pen color, was actually 24,000. Let me just see what 24,200. And you'll be like, oh my goodness, there's a difference. So I expected it to be this, and it's actually 24,200. Now, so you find the difference, 24,200 minus 22,610, and you get a difference of 1,590. Remember, this is a purely accounting difference. This whole £1.75 is an assumption. This 2 hours is an assumption. We get here and we find the difference. So this is your accounting. This is your fixed overhead variance, if you like. Just the fixed overhead variance. This is just overall. But this doesn't mean anything right now, because we know that, first of all, fixed overheads never varied with volume, but we've treated it as though it varies with volume. So we're bound to have this strange difference. The question here is, what is this really made up of? Like I said to you, the real variance, the expenditure variance, which we calculated earlier on, was the actual variance that happened, which was the difference between, if you like, what we thought it was going to be and what it actually was 1,240. So we know that from this 1,590, 1,240 is actually the expenditure variance. We know definitely from this difference, from this 1,240, that is actually the actual expenditure difference. The question is, what is the rest? And the rest is 350, and the rest really is a volume variance, right? Volume. Because remember, you thought you'd built everything around this 6,560 units. You made 6,460 units. So you actually made 100 units less, and you built and based and spread your costs based on that. But actually, this is what you've actually produced. So we now have a variance due to volume of 350. Now, this is an accounting variance almost. This is to do with accounting. So this is what the accounting issue is. I mean, if you had made 6,560, we would be bang on the 1,590. Sorry, on the 1,240, if you like. But, you know, what we now have is a scenario where you now have a volume variance as a result of you making less units than you actually thought you would make, because you thought you'd make 6,560, but you've made 6,460. So what am I saying? Overall, your accounting difference is 1,590, and I'm telling you that this difference really is due to the 1,240, which is your expenditure variance, and the 350, which is your volume variance. So that's the first bit that we need to kind of be happy with. So what I've tried to show you is actually how we actually arrive at the, if all you were asked to was calculate the fixed overhead variance, well, it literally would be, well, what did I expect the overheads to be per unit times all the units you produced, and compare that with what actually happened. But typically, what you're typically asked is to go further and tell us what the expenditure variance is, which is really what the real variance is. And therefore the rest must be due to the volume changes, because your spread hasn't worked exactly as you felt it would, if you like. So we'll stop in this part, and in the second part of the video we'll look at the breakdown. What we can do is actually investigate that volume variance. Why did we end up, if you like, producing 100 units less It's almost like efficiency again. What's happened? Why did we end up producing 100 units less than we thought we would, given what we expected and given what we actually did? So we'll see that in the next video.